Next question is, given the company's stock decreases, means if at all the price of the security falls down, what is the percentage return on the investor's position? That is a question. Is it higher, equal or lower than 7% company stock decrease, and why? That is a question. What does it mean? It means that if at all a trader has taken a long position in futures market and the price of the security declines, on the very next day, if at all he squares off his position, means he is entering into the reverse of the original futures contract. With that, the gain or loss that say he is going to have is 7% or more than that or less than that. That is a question. And whatever the answer that say you give, for that say you are required to give the reason. First of all, I want you to tell me what is the percentage return if at all investor is say squaring of the position on the very next day. Please write down a note before we write the answer. Question number E. Over here, we are required to find percentage loss to trader, comma, who has entered into futures contract, comma, to buy security. Full stop. I want you to tell me answer of the question. So write down with paragraph. If the trader will enter into a transaction, comma, to square off his long position on next day, comma, then he will have percentage loss calculated as under. So it will be found as loss divided by amount into 100. We understand that say basically trader had made investment of an amount of 21,100, that is the initial margin. On the next day, if at all he enters into the reverse of the original futures contract, then with the square of, he will get in his account 5980, means he will be having loss of 15120. So if at all he is having a loss of 15120 on investment of 21,100, means he will be having a loss of 71.66%. So he is having a loss of 71.66%. This is the loss that say he is going to have. So we can see that there is a huge loss of 71.66%. if at all the price of the security declines in the spot market just by 7%. Now the question says that, say, why there is a situation like this? The reason for that is very simple, because what happens that, say, you're required to make the payment of only a partial amount when you enter into the transaction, and if at all the price decreases, then in that case for the entire lot, whatever the loss that, say, you're required to bear. That is the reason, say, there is a huge possibility of the gain if at all the things are favorable to you, and there is a huge possibility of a loss when the things are unfavorable to you. So write down answer. We understand that trader is required to pay only an amount of margin, comma, so percentage gain or percentage loss will be substantially more. Full stop. So over here we can see that if at all we take into account this practical quotation, then at this point of time for 25th of November the futures price is 2594.4. The amount of the margin that you have to pay is 1,43,623. Now what happens at, say, suppose I enter into the futures contract for 25th of November to buy the security at 2594.40. That is the price at which, say, I take a contract to buy. So for me what will happen? The purchase price is 2594.40 into 250. 2594.40 into 250. So it comes to 6,48,600. Okay. Now basically I have to make the payment of the margin, that is the amount of the investment is only 1,43,623. Now let us say that the price of the security falls down, and say just I am taking an assumed figure, the price of the security falls down to 2550, the futures price, and I am expecting that, say, the price will further fall down, so I square off the transaction. So what will happen? 2550 is the price at which you will enter into the transaction for sale, again into 250 shares. So 2550 into 250, that comes to 6,37,500. That is the sale price. So difference of that is a kind of loss that you have. So the amount of the loss that you will have is 11,100. The amount of the investment that, say, you had made was 1,43,623. So what will be your percentage loss? It is, investment was 143,623. 143,623. So the loss is going to be 7.73%. This is the way that you will be having a loss. Now you can see that, say, 2550 minus 2594.4 divided by 2594.4 into 100. So when the price of the security reduces by approximately 3.64%, in that case you will be having, say, the loss at the rate which is, say, 7.73%. The reason for that is once again very simple, because the margin is only what you are required to pay, say, when you initiate the transaction. This is the way the percentage gain or percentage loss will be more when you do the futures trading in comparison to, say, the stock trading that is in the cash market. Giving you further explanation, instead of entering into the futures, suppose I would have purchased the shares from the spot market equal to worth rupees 2,11,000. The price reduces. With the reduction of the price, say I entered into the transaction to sell the security, because I am expecting that the price of the security will further fall down. Then what will happen? I will be having a loss of 15,120 on investment of 2,11,000. Suppose I had purchased the shares from the spot market. So if at all you compute the answer in percentage term, the loss will be 7%. 15,120 divided by 2,11,000 into 100. That comes to very near to 7%. Otherwise, it will be exactly 7% if at all we compute in terms of number of shares. I just explained that to you. Spot price of the security is 200. You make investment of 2,11,000. So 2,11,000 divided by 200. So you made investment in 1055 shares. You are having same 1055 shares when the price reduces. 200 minus 7%. So it reduces to 186. So 186 into 1055. So the value will be 196,230 for the stocks, for the shares in which you made investment. So 196,230 minus 2,11,000. So the amount of the loss will be 14770. So what will happen? Loss will be 14770 on investment of 2,11,000. So in percentage term, it comes to an amount of 7%. So when you are dealing in the cash market, then in that case, we understand that the percentage gain or percentage loss will be substantially less in comparison to when you are dealing in the futures contract. So we understand that the F&O market, we are going to understand the option market later on, but the F&O market is considered to be very risky because of this reason, that in case of the cash market, you will be having the percentage gain or loss which is distributed like this, while in case of option market, you will be having the percentage gain or loss which is distributed like this. That is, volatility will be substantially more in case of the futures market in comparison to cash market. This is what we understand.